Preparing for a collateral management and margin operations, ISDA CSA, VM, margin calls interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is collateral management, and why is it important in OTC derivatives? The interviewer wants to assess your grasp of counterparty credit risk, collateral's role in mitigating exposure, and how margin operations protect the firm from market moves and settlement failures. While answering, focus on daily exposure calculation, collateral exchange, risk reduction, operational discipline, and how collateral management connects legal agreements, credit risk, treasury liquidity, and settlement operations. Collateral management is the daily process of securing exposure with eligible assets. In OTC derivatives, a counterparty can owe us money as markets move, so we calculate exposure, compare it to thresholds and minimum transfer amounts, issue or receive margin calls, and settle collateral. Good margin operations reduce counterparty credit risk, support regulatory compliance, and protect liquidity. The key is accuracy, timing, and strong dispute management across front office, risk, legal, and operations. Question 2. What is an ISDA Credit Support Annex, and what key terms would you check before processing a margin call? The interviewer is testing your understanding of the legal framework behind margining, especially how the CSA defines collateral rights, obligations, calculation mechanics, eligible assets, dispute rules, and operational responsibilities. Make sure to cover the ISDA Master Agreement link, valuation agent, thresholds, MTA, eligible collateral, haircuts, interest, currencies, call timing, dispute mechanics, and why static data accuracy matters. A CSA, or Credit Support Annex, is the collateral agreement attached to an ISDA Master Agreement. It tells us how to collateralize derivative exposure, valuation timing, thresholds, minimum transfer amounts, independent amounts, eligible collateral, haircuts, interest, currencies, and dispute procedures. In practice, I would never process a margin call by only looking at system exposure. I would confirm the CSA terms because one wrong threshold or haircut can create a bad call and a counterparty dispute. Question 3. How would you explain the difference between variation margin and initial margin? This question evaluates whether you understand current exposure versus potential future exposure, regulatory margin requirements, operational treatment, segregation, and how VM and IM behave differently during market stress. In your answer, talk about mark-to-market exposure, future closeout risk, daily VM exchange, IM calculation methods, segregation requirements, rehypothecation restrictions, and regulatory uncleared margin rules. Variation margin covers current mark-to-market exposure. Initial margin covers potential future exposure during a closeout period. If a swap moves $2 million in our favor, VM should bring that exposure back to collateralized. IM is different. It is usually segregated, cannot be rehypothecated under uncleared margin rules, and is calculated using regulatory schedules or approved models. VM is about today's value. IM is a buffer against tomorrow's gap risk if a counterparty defaults. Question 4. Walk me through the end-to-end margin call lifecycle, from valuation to settlement. The interviewer wants to assess your practical process knowledge, including exposure production, CSA application, call issuance, agreement, settlement, booking, reconciliation, escalation, and exception management across the daily margin cycle. Be sure to mention trade data, valuations, netting set, thresholds, MTA, collateral held, call communication, dispute tracking, payment or security settlement, reconciliation, and management reporting. A clean life cycle starts with trade and market data feeding the exposure engine after end-of-day valuation. The system applies CSA terms, nets exposure by agreement, subtracts collateral already held, checks thresholds and minimum transfer amounts, then generates calls. Operations issues or receives calls, agrees amounts, books collateral movements, and monitors settlement. If the counterparty disagrees, we record a dispute, investigate pricing, trades, FX, or CSA setup, and escalate aging breaks before regulatory or credit deadlines are missed. Question 5. What are threshold and minimum transfer amount, and how do they affect a margin call? The interviewer is testing your understanding of core CSA economic terms and whether you can apply them numerically rather than only define them conceptually. While answering, focus on unsecured exposure tolerance, operational efficiency when collateral is actually transferred, how these terms affect call size, and why incorrect setup causes disputes. Threshold is the unsecured exposure a party can tolerate before collateral is required. Minimum transfer amount is an operational efficiency limit. If the call is below it, no transfer is made. For example, if exposure is 5 million, threshold is 1 million, collateral held is 2 million, and MTA is 250,000, the call is 2 million. Since it exceeds MTA, we call for collateral. These terms materially affect liquidity, disputes, and credit utilization. Question 6. How do eligible collateral and haircuts work under a CSA? This question evaluates your understanding of collateral quality, legal eligibility, valuation adjustment, concentration risk, liquidity risk, and operational checks before accepting cash or securities collateral. Make sure to cover permitted collateral types, currency, rating, maturity, securities haircuts, cash versus non-cash collateral, valuation percentages, and the risk of accepting ineligible assets. Eligible collateral is whatever the CSA permits, but I always distinguish legal eligibility from economic suitability. Cash in the call currency is usually simplest. Securities require haircut, concentration, maturity, rating, and settlement checks. A haircut reduces collateral value for market and liquidity risk. So $10 million of bonds with a 2% haircut only credits $9.8 million. Operations must validate eligibility before accepting assets, because ineligible collateral may leave the exposure effectively under-collateralized. Question 7. A counterparty disputes your margin call. What steps would you take? The interviewer wants to assess your problem-solving approach, control mindset, escalation judgment, and ability to diagnose disputes caused by pricing, trade population, collateral balances, FX, or CSA interpretation. In your answer, talk about confirming the call calculation, identifying the break source, agreeing undisputed amounts, documenting evidence, aging disputes, escalation, and communicating clearly with internal stakeholders. When a margin call is disputed, I first separate timing noise from real differences. I compare trade population, valuations, FX rates, collateral balances, CSA terms, and prior day settlements. Then I quantify the undisputed amount and ensure it is paid where required, while documenting the disputed component and root cause. Escalation matters. Aged or material disputes should go to valuations, risk, legal, and relationship teams. The goal is quick resolution without weakening control discipline. Question 8. If exposure is 12 million, collateral held is 7 million, the threshold is 1 million, and the MTA is 500,000, what margin call would you issue? This question evaluates whether you can apply CSA mechanics under interview pressure, calculate a collateral requirement accurately, and explain the logic without confusing exposure, threshold, collateral held, and MTA. Be sure to show the formula clearly. Exposure less threshold equals required collateral. Subtract collateral already held, then compare the resulting call amount to the minimum transfer amount. First, I would compute net exposure after applying the CSA netting set. Assume we are in the money by $12 million, hold $7 million collateral. Threshold is $1 million and MTA is $500,000. Required collateral is exposure minus threshold, so $11 million. Because we already hold $7 million, the call amount is $4 million. Since $4 million exceeds the MTA, we issue the call, subject to rounding, currency rules, and any independent amount. I would also reconcile against yesterday's movement. Question 9. Why is netting important in collateral management? The interviewer is testing your understanding of legal netting, exposure aggregation, enforceability, credit risk reduction, and why correct trade-to-agreement mapping is essential for accurate margin calls. While answering, focus on netting sets, offsetting positive and negative trade values, ISDA enforceability, reduced collateral movements, lower credit exposure, and the operational risk of wrong agreement mapping. Netting is critical because collateral is usually calculated at the agreement or netting set level, not trade by trade. If one swap is $8 million in our favor and another is $5 million against us under the same enforceable CSA, the net exposure is $3 million before collateral terms. That reduces settlement volume and credit exposure. But netting only works if trades are correctly linked to the legal agreement and the netting opinion is enforceable. Question 10. What would you do if agreed collateral fails to settle by the cutoff time? This question evaluates your operational risk awareness, ability to manage failed settlements, understanding of SSI and custodian processes, and judgment around escalation when credit exposure remains unsecured. Make sure to cover settlement instruction checks, counterparty communication, custodian follow-up, exposure reporting, escalation, fail monitoring, credit impact, and documentation of the failed movement. If collateral fails to settle, I treat it as both an operational break and a credit risk issue. I would confirm instructions, cutoff times, SSI setup, custodian status, cash availability, and whether the call was actually agreed. Then, I would update exposure reporting, chase the counterparty or custodian, and escalate if the fail creates unsecured exposure or regulatory noncompliance. Same-day communication is important because a small payment break can quickly become a credit exception. Question 11. How is interest on cash collateral handled? The interviewer wants to assess your understanding of collateral interest accruals, benchmark rates, CSA terms, operational reconciliation, and how small rate or balance errors can create disputes. In your answer, talk about daily accrual, benchmark rates by currency, day count, collateral balance history, monthly settlement, negative rates, reconciliation, and agreement-specific interest provisions. Cash collateral usually earns or pays interest according to the CSA, often based on an overnight benchmark in the collateral currency, such as SOFR, SONIA, or Euro STR. Operations accrues interest daily, agrees it with the counterparty, and settles it monthly or per agreement terms. I would check rate source, day count, negative rate treatment, currency, and collateral balance history. Interest errors are common because they combine market data, legal terms, and settlement timing. Question 12. What impact have uncleared margin rules had on collateral management operations? This question evaluates your knowledge of regulatory margining, especially how UMR changed VM and IM processes, documentation standards, segregation requirements, custodian workflows, and operational control expectations. Be sure to mention mandatory VM, regulatory IM thresholds, segregation, eligible collateral rules, model or schedule calculations, custodian tri-party workflows, deadlines, reconciliations, and audit evidence. Uncleared margin rules made margining more standardized and more controlled. For covered entities, VM is exchanged under regulatory standards. and IM may be required once thresholds are exceeded. IM is typically segregated with a third-party custodian, calculated using schedule or approved models, and subject to strict eligibility and documentation rules. For operations, UMR means tighter call deadlines, reconciliation, custodian workflows, breach monitoring, and evidence that disputes and settlements are handled within regulatory expectations. Question 13. What is the difference between independent amount and regulatory initial margin? The interviewer is testing whether you can distinguish contractual credit support from regulatory margin, including purpose, calculation basis, legal treatment, segregation, and potential double counting issues. While answering, focus on independent amount as CSA negotiated collateral, regulatory IM as rule-driven potential future exposure collateral, segregation differences, calculation methodology, and careful legal interpretation. Independent amount is a contractual collateral add-on negotiated in the CSA. Regulatory initial margin is driven by uncleared margin rules. They can look similar because both sit on top of current exposure, but the purpose and treatment differ. IA may reflect counterparty-specific credit concerns or deal economics, while regulatory IM covers potential future exposure and is usually segregated. In practice, I would read the agreement carefully to avoid double counting or missing offsets between IA and IM. Question 14. What controls would you expect in a strong margin operations function? This question evaluates your control mindset, understanding of operational risk, and ability to identify preventive and detective controls across valuation, static data, call approval, settlement, and dispute management. Make sure to cover maker-checker reviews, reconciliations, static data governance, exception reporting, call approvals, dispute aging, SSI controls, settlement monitoring, KPIs, and management escalation. Strong controls start with complete data. Trade population, valuations, CSA terms, collateral balances, and settlement records must reconcile. Then I want maker-checker approval for calls, independent price validation, exception reporting, dispute aging, SSI controls, and daily sign-off. Changes to legal terms or counterparty setup should be controlled through static data governance. I would also monitor KPIs like call timeliness, settlement fails, unresolved disputes, and collateral eligibility breaches, because margin errors can create real credit and liquidity exposure. Question 15. During a volatile market day with unusually large margin calls, how would you manage priorities? The interviewer wants to assess your judgment under pressure, ability to prioritize risk, communication with Treasury and stakeholders, and discipline in maintaining controls during high-volume margin cycles. In your answer, talk about materiality, exposure risk, liquidity impact, valuation checks, dispute focus, settlement cutoffs, Treasury coordination, custodian capacity, escalation, and avoiding control shortcuts. In a volatile market, I would prioritize material exposure and settlement risk. First, confirm valuations and market data are refreshed. Then review large calls, counterparties near thresholds, and any age disputes. I would communicate early with Treasury because cash collateral demand can create liquidity pressure. I would also watch operational capacity, cutoffs, custodian queues, and failed settlements. The objective is to keep the firm collateralized without accepting poor controls just because volumes are high. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.